Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we're going to talk about, what's going on in the world, especially on a geopolitical side. And our analyst, Osama, was kind enough to put a nice little chart together of all of the things that are really impacting sentiment right now, both bullish and bearish. And you get an idea on how it's kind of balanced, and it's just a matter of what headline is really driving us that day. Is it going to be a bullish move, a bearish move? So we want to go through what's happening there, what we think is going to be the most important driver over the next few weeks. Then we're going to go into, obviously, refined product demand fell as we said it would. It fell too much, so now we'll have a bit of a bounce. We have a gasoline side just below about 9.1 million. And the reason why it's now below 9.1 is just because a lot of kids are back at school. So as you have kids going back to school, you typically have that slowdown that just filters down. Nothing crazy. We're not getting this huge drop. It's just that seasonal swing as we start to see that slowdown and then it accelerates as we go into September with the final kids going back to school the day after Labor Day. So then we're gonna wrap up with Chinese exports and how when we look at crude, there's a record crude on the water. I don't think that's surprising to anyone, as we've seen floating storage increase in the Middle East and West Africa. And there's just more crude just because, again, miles per ton have gone up because of all of the shifts from Russia. So now when we start just looking, I think at the market sentiment tracker, I think it's important to see how these risks are shifting, because when you look at the bullish side, you have the geopolitical risks, which are obviously really front and center. So when you start looking at a lot of the inflation side, you start to look at a lot of the different shortfalls, that's increasing again on the geopolitical risk front. But then when you start turning over to the recession side and you have that bearish front, you have the bullish dollar, you have sticky inflation, which again is just hurting people's pocketbooks. This is emerging markets, developed markets, a broad view, and then OPEC and their different shifts. So it's funny because depending on the headline, OPEC can be on the bearish side, they can be on the bullish side. So recently they had been on the bearish side because there was talk about the Iranian deal, them coming back, bringing some of that crude back on the water. And then Saudi Arabia came out and said that they were going to be cutting some of their production because they think there's a disconnect between the physical market and the paper market, which then became a bullish side of the backdrop. Now, in the third segment, we're going to talk about, and we've been talking about it the last few weeks, how there's been a large increase in floating storage within the Middle East because they mismanaged their OSP, their official selling price. I guess they assumed that Brent was going to stay at a significant premium to Dubai, but that has since collapsed, which is now making their crude very expensive, which is leaving it in the water. So some of the things that we want to look at when we start really trying to weigh what is going to matter the most as we go forward. And you can kind of see how there's a fair amount on both sides, which is why we've been saying that we're just here. We think that, one of the things that we've been saying is that, 102, 103 on the Brent side is fairly comfortable given the back and forth, which if you think about WTI, that probably equates to 96, 97. As we go through the end of the year, there's likely going to be a bit more on the recession front, and that's just because of, again, slowing demand. We understand that there's a shortage of supply, but when we start factoring in some of the other things we're going to talk about, which is natural gas shortfalls, electricity issues, that's again going to show that shortfall in supply. So even though demand is going to diminish, we still have that supply concern and this fear, which again is going to provide some of that uplift, especially when you look at, Germany took, I think, their imports of Russian crude at a 3-year low and falling. So you're getting, again, this shift in terms of just underlying flows, and we'll talk about it tomorrow in the Econ show. it has created a problem for the current accounts balance, which have gone from positive to negative in Europe. And that's only going to get worse when we start looking at as we prepare for the winter. So now when we start looking at some of the other key pieces, again, that supply component, it's Kazakhstan. So when you look at the 3 moorings that CPC loads at, 2 of them, they found cracks, they found structural damage. So they're in the process of repairing it, but that's going to limit the mooring. So instead of having 3, you have 1, and that 1 is at a reduced number just because there's a lot of equipment, there's a lot of things moving in to fix the other 2. So you can't have that last mooring operating at max capacity because you have some of those issues. So what do we have going on? Kazakhstan they faced months of major disruptions amid repair work on 2 out of the 3 damaged moorings. Dive teams uncovered cracks on where subsea hoses attached to buoyancy tanks at 2 moorings at the CPC oil loading terminal in the Black Sea. The 3rd mooring is running in intensive mode and needs to be inspected. So again, you're getting an idea of where some of those limitations are. Now, holistically speaking, it's not going to be a huge issue for the global market. It's just going to increase the amount of pain for Europe. So Europe is relying more and more on Libya. They need that Libyan crude. If we started to see, so CPC, you can see here, there's about 400,000 barrels a day that's come off. And not to say that isn't meaningful to the global market, because it is. 400,000 barrels a day is 400,000 barrels a day. But Libya coming back from 600 back to about 1.1 is a positive but what happens if Libya goes away? What happens if there's more upheaval? Because there's just kind of a standoff in Libya, which again keeps everyone on a knife's edge, where you have CPC now. If you throw in Libya, and Libya would be 500, then here you have 400. So then now you're starting to look at something close to 1 million barrels a day, which is only going to make Europe that much worse. Now they have cut runs in some of the facilities, which has diminished crude demand. But there's still needs here, and it's a matter of where is this going to come from, and it's going to come from other areas, and that's where we're going to want to look at what kind of flows are we seeing into Europe. So when you start looking at why do the flows matter so much, well, look at power. So power is at an equivalent of about $1,000 a barrel of oil. And it's just Europe natural gas 1 year out, French 1 year power out, and you're just seeing the flows going up, which is why you will get some switching. The problem is the capacity to switch. So some facilities don't have dual fuel capacity. Anything that did have dual fuel has been decommissioned. So there's just a matter of, well, what can come back, and that's where if we did get to, and I think we're going to see as much gas to oil switching as we can, or I should say oil to diesel. But diesel is super expensive. You're talking about middle distillate that is a net short everywhere in the world, especially in Europe. That is going to create some of these issues, which is why we do have a flotilla of Asian middle distillate going into the European markets, and we should see fuel oil going from the European markets into the Middle East and Asia, especially Central Asia, when we look at that flip. So essentially very low sulfur into Europe, high sulfur fuel oil and fuel oil out, and that's where you're going to see some of these pivots, which is increasing cost, but you're just getting an idea that it makes sense to essentially switch and do whatever you possibly can. So when we look at Europe and Germany specifically, they've put a number where they want to cut current natural gas demand by about 15%. And they're trying to hit that to make sure that there's enough natural gas as we go into the winter months. So when you look at the ships coming from Asia, as we said earlier, Asian refiners are set to send a flurry of diesel shipments to energy-starved Europe. And here you can see that we're getting to about 200,000 barrels a day, and it's likely to continue to trend higher. There's only so much higher it can go, though, because there's ship limitations, pricing limitations, refinery limitations. So when you think about Saudi Arabia, now we have to look at what Saudi Arabia is doing. So they're discussing cutting exports or cutting production, but They're coming to the end of summer burn, so that's going to alleviate some of those needs. And they're taking in a significant amount of Russian diesel, Russian distillate, and exporting what they're making internally, which gets around sanctions, because they'll essentially burn what they take in from Russia and export what they're making internally. And if you think about the ARB, it's a massive ARB because Russia's selling at a discount, and diesel selling at a premium. So they're sitting there, they're burning the cheaper stuff and selling the expensive stuff and making the difference in between, which is obviously a windfall for Saudi Arabia, Kuwait, and some of the other GCC nations. So now when you look at European gas storage, you can see that it continues to trend higher. So we're well above the 10-year average or 11-year average. But the concern is not so much what is it right now. It's if there is a cold winter, will they have enough to manage? And that's where there's a mixture of two different things. There's concern about where is storage going to be, because if they start running short, where are they going to get it from? They can't call up Russia and buy, or they can't buy more from Russian pipe. They have to go into the international market and the LNG market. And is there enough in there? So there's a certain amount of panic of, we need to make sure that we have more than enough storage, because in case we have a snow bomb, or in case we have a cold snap that extends, they need to make sure that there's enough to cover that, and then have enough left to get through the rest of winter. And that's some of those panics. So, but then there's the panic where, oh my God, the world is ending. So there's a mixture of two, and it's a matter of trying to manage this. And another key way to do that is obviously by hitting demand. And how do you do that? You just send prices to the moon. So almost the entire European continent is now operating at electricity prices above 600 euro per megawatt hour, which is, again, roughly to 1,000 barrels of crude. The last decade average cost of electricity was between 20 and 30 euros per megawatt hour. And again, you're seeing that surge, but this is also helping to curb demand. But it's also hitting on an international, on a economic level, because you're seeing industrial production shut down. You're seeing things get cut, utilization rates get shaved, which is increasing some of this pain. So then when you start looking at just how parabolic the move has been, you get an idea of just where electricity prices are and what this is going to continue to do as, again, companies really try to pivot away and reduce the total utilization rates. But it's important to take this into context, because I know we've gotten a lot of pushback from different people saying that, oh, well, by me, things are going great and everybody's driving. Well, this is a retail and recreation mobility data set based on country. And you can see that there's been some areas have done better than others. Canada is one of them that has done better than all of the others. Germany has done a bit better. But then when you go forward, Germany's starting to roll over. Canada's still remaining fairly strong. France is rolling over. And Europe in general is the one that is leading us down, with the U.S. fairly flat. So as we've been saying, we don't expect much change from the U.S. It's really Europe that is going to drive some of that down, which again is going to be a benefit in terms of just cutting demand due to high prices. So for developed countries, retail and recreation mobility has recovered swiftly this year. Canada and Germany above baseline, but even as the UK lags, improvement over the past year is notable. And again, there are things that have improved, but now as you have inflation picking back up and you have just the pressure in general on economic activity, it's only going to get worse as you have electricity prices just going to the moon, which is going to increase prices of goods, which is going to cut the availability of goods because everyone is cutting run rates and utilization rates. So that's going to increase a lot of that pain when you start looking at how Europe is going to manage. So, and the U.S. in general is going to benefit because we are going to be able to export into the European markets, which is going to continue to be a huge buyer of whatever they can find. And the U.S. is going to be able to answer that call as well as what is going into Asia. And a lot of that is really derived from just the elevated price of Saudi Arabian crude and other GCC nations, which is going to support what's coming from us. So the U.S. had a draw of 3.28 million, 45.9 million below the 5-year. But when you look at, again, the drivers of it, it's PADD 2 and Cushing, which both had increases. PADD 2 increased 950,000 barrels in storage, and a lot of that was driven by imports. We had a big surge in imports, which will come back down. But as we said last week, we expected a nice little spike, and then it'll fade a bit as Cushing continues to normalize a bit with 430,000 barrels into storage. But again, still 16 million below. So between the 18 out of Cushing, 16 out of Cushing, PADD 2, 18, that is the lion's share of where the crude stock has been dropped. With PADD 3, had a draw of 1.74 million. That's 5 million below the 5-year, and it's driven based on imports remaining very low, while exports again still holding at our number of about 3.7 million barrels a day. And because of the European problems, this is going to continue to pull more U.S. crude into Europe. CPC not shipping to the same level. That's going to pull more U.S. crude into the market. And again, just keep us supported at this very elevated level, which we've seen here. And then PADD 5 had a drop in imports, which was the result, which resulted in 2 million barrels coming out of storage, but it's only 1 million below the 5-year. Now, there was another drop of 100,000 barrels in a day in production, but there's a certain amount of timing in that in terms of when did the offshore go offline, when did it come back online, when was it registered? Because based on everything that we're seeing right now, we're still just at about 12.2 million. So again, it's just a matter of when was this registered. So we do think this will just come back, either all at once or 100,000 barrels, by week. But again, we don't see it going above 12.2 at the moment. We do think we can get to about 12.3 as we get through September and October. Just with some pickup in activity, but that will again be reflected a little bit later after what we're seeing, because the frac spread count is that leading push. So we typically see it first before it shows up in these numbers. Now, the physical crude market in Asia is softening as oil from the U.S. and Brazil flows into the region, boosting competition for Middle East producers. And again, it's just monetary, it's just cost. So OSPs have been able to pull more Latin American and U.S. crudes into Asia as well as into Europe. And the flow coming from Latin America has helped to kind of buffer some of those losses when you look at CPC, because even though we're losing a certain amount of Kazakhstan crude, their demand has already started to fall along season, a little bit more than seasonal lines, just because demand never got back to normal. So now demand is falling, but falling within the seasonal band. So it's coming at a time that demand is normally slowing. So that's why we're saying that there's enough tailwind to really keep us at this elevated price, even though there's some of these headwinds of a recession, a slowdown in demand, seasonal shifts. It's because of that supply coming off that's going to keep us at these elevated levels. August loadings of clean fuels from Asia to the Americas rose by 65,000 tons from a week earlier to 405,000 tons as of Monday, which is a 5-month high, because the U.S. also has a huge distillate shortage. So again, when you look at the underlying market, the Atlantic Basin is just going to have a sucking sound of as much diesel as possible that can flow into the U.S. and the European markets, while Asia pulls more Russian naphtha, because again, Russia also produces a lot of condensate. So that's going into Asia, which is capping the amount of LPG that we're exporting. But again, it's just capping it. It's not slowing it. It's just keeping it at this elevated point as we continue to see these shifts in the international markets. Inventory in pad 3, you can see here again, as we said, just fairly flat. It's following that seasonal trend that we've seen with 2017 and 2021, where you had kind of that pivot. Again, we think it just follows more along the lines of where we were in 2017, and we start to get those increases as we come into the end of September. But one of the things that we've been saying from the beginning is that it's just flat. But you can see as we go through the end of September into October, there's usually that kind of that steady drawdown. So it's going to put us in a fairly comfortable position, because that 5-year you can see is massively overstated because of that 2020. But when you look at it, it's the fourth highest year ever outside of 2020. So again, just it's very normal in pad 3. And I think that's the biggest key and that's why we're seeing a lot of these different shifts in terms of exports and imports, where imports remain low, exports remaining healthy, but yet we still have a very normal amount of crude in pad 3. Then when you look at Cushing, as we were saying, just slow grind up. It's going to be very measured. We're not seeing a huge surge, but we do continue to see a bit of an increase, which again is coming from U.S. production and just the balancing act that pad 3 is trying to do between what is in storage and what is going to the international markets. Runs the utilization rates was up just a bit by 0.3, even though total barrels per day came down slightly. And again, it's just because of pad 3 in general. So you can have so this is where the fun with numbers comes in, because you can have total run thousands of barrels come down, but utilization rates go up just because you have some mega facilities in pad 3. So even though on a percentage basis it's come down a small amount, it can have a fairly sizable 1,000 barrels per day, which is why there's that slight disconnect. But again, it's right in line with where we should be right now. It's actually a little bit low on the utilization rate. We should be closer to 94.5. But just with what we had some unplanned downtime, some flaring, which resulted in pad 3 coming down a bit. You can still see it's fairly in line with the 5-year. It's not crazy. It's just the problem is obviously with the underlying throughput, and that is also left a little bit extra crude in the storage, which then got pushed in the export market. And slowed some of the imports, because we did have floating storage go up. So we do think those imports are going to come back into the system. Again, not a huge number, but we will get some more imports into pad 3. European gasoline exports to the U.S. Started to increase. Again, they're at about a 3-month high. And just given the amount of gasoline in Europe and how little gasoline we have in pad 1, we should see that open up a bit. But day rates still remain very elevated. Utilization rates, again, you're right in line. You're above the 29-year average. This is a bit noisier. I apologize. I didn't realize that we normally do the 10-year the last few weeks, and you can see it's a little low in comparison. But when you look at just the demand in general, that's what's again keeping us a bit muted. Again, not by a huge number, by about 1.5% utilization rate, which again is some of that delta when we're looking at some of pad 3 specifically, seeing that storage remain a bit high, even though imports remain so low. And just looking at imports, when we talk about imports remaining low, the pad 3 had a small drop of 106,000 barrels a day, but that's over 1 million barrels below normal. And that's where we continue to see those impacts in terms of just not a huge amount of crude coming into pad 3. Obviously, pad 2 had a big bump of 348,000 barrels a day, which is right in line with what we were seeing, that new kind of breakout. Well, it'll drop back down, but again, stay elevated in comparison. Pad 5 will get a little bit of a bump, and just in total, because of pad 2, total imports were up 40,000 barrels a day, but that's still 949,000 barrels a day below normal. So again, that's when you start looking at the different shifts. The U.S. is just not pulling in the same amount of crude it has in the past, which is helping to offset some of those declines. But those declines are also offsetting the less we're buying. So again, that's keeping us at this elevated point, which is something that we do think is going to remain fairly elevated, on the upper end. It then just puts into context. So we were expecting to see 2020 new 2022 highs for imports. Instead, we're essentially coming into the lows for 2022, and that's something that we do think turns up. But it's getting a little long in the tooth, and we will see this not get to the levels that we were expecting, but still stay fairly lackluster and at the very low end of this cloud as we go into the next few weeks. Pad 2, here you can see it's a new 2022 high, and it will come back down, but it's going to come back down in the sense of still stay above the 5-year average and just stay at the very high end of that cloud, or at least above that cloud, keeping us on an elevated basis. Implied demand, you can see here, gasoline dropped 914,000 barrels a day. We still have it just below 9.1. So again, this is an over-exaggeration to the downside. It will bounce back, and between the 2 weeks, it should come close, just above 9 million barrels a day. Again, the lumpiness there. Distillate holding firm, down slightly by 37,000 barrels a day. We think it really starts to just flatline here until we get into winter, and then we're going to get that step up of heating oil demand, which is going to drive that up. But again, this is also looking at it on a seasonal basis, because so against the 5-year, we normally get an increase. So it'll increase along seasonal lines while gasoline continues to trend down on along seasonal lines. Same with jet fuel. Jet fuel hanging in right at about 1.6. And remember, our top end was about 1.55. So still a bit higher than what we were expecting, but again, still a solid number. Resid back to the kind of that basis, and then propylene down 274,000 barrels a day. But we are coming into the harvest next month. That's going, depending on how wet or dry the harvest is, will dictate how much additional propane we're going to consume. But we are getting more slowdowns out of petchem, which is leaving more propane in the system. But we are exporting, which is, again, keeping us fairly strong for NGL price, but again, on the lower end, just given some of the shifts. U.S. imports of U.S. gasoline jumped to the highest in 6 weeks, and we do see it trending a bit higher, just given some of the back and forth, coming in at about 229,000 barrels a day. Implied demand, you can see, took out the bottom based on this data from 2020. Again, we think that's wrong. It's something closer to 9.1, which, if you think about 9.1, you're still at a very low end of this scope, but you can see how just lumpy this is. But again, when you average it out, you're coming in at that 9.0, 9.1 level. So then when we look at oil inventories excluding SPR, here we are just kind of sitting here fairly flat, again, right in line with where we were in 2015. But you can see that drop down that we had in 2020, in 2019. Again, I'm sorry, not 2020, 2021. So that's where we think things just, again, flatline and average out, because things are going to stay fairly flat here. Crude supply, small dip, but again, will bounce just a touch. Nothing, again, flat is what we expect. Then when you look at total commercial stockpiles and products, as we've been saying, flat, just again, sideways, just staying sideways, because some of the comps get a bit easier. But again, we're still going to be at the low end of this, just because of pad 1, distillate on a U.S. level. But again, distillate and gasoline mixed in because of pad 1, which is going to keep things very depressed. Which, when you see here, gasoline, and it's what's happening, what we called for last week is starting to roll out, a very sideways move. And that's what we are going to continue to see, is storage remain fairly lackluster, just going sideways, not much up or down, just given some of the underlying economics that we continue to see, where demand is dropping, but that's where we continue to see things rolling through. Distillate, again, just the third lowest it's ever, or at this point it dipped back below, second lowest over the last 29 years. So all of this is going to be a huge issue. Jet is going to come down because more and more of it is going to be preserved. Because remember, kerosene and distillate are very close together, kerosene, diesel in general. So you can go into one or the other, and that's going to keep this fairly flat. And then when we look at where the crude curve is, here you can see it's fairly normal, but then there's that bigger steep drop off. And that drop off is really being driven based on Iran coming back and what is going to be some of the impacts from that demand, because there's a lot of that concern. So as the demand drops, this is trying to signal like you should pull back a bit on investment. Again, we think it's wrong. We do think that you get that shift up, but you can see the strength still remains in some of those, because one of the things that we've been talking about is December and July are the two most liquid months when you go further down the curve. And we think that things are still holding fairly firm. We don't really see a trade here right now, just because the front month is going to be fairly volatile. We don't see too much up or down. But then when you start looking at further down the curve, if there's any weakness that comes in, and one of the things that we had been saying is you kind of wait for the Iranian news to hit, or where Europe and Iran officially make peace, and you'll probably get a decent whack off of that, probably $3 to $5. That would be, I think, a good entry point, just given where we are, because I think that overreaction would occur. Then when we look at floating storage, here's that increase that we were talking about. Depending on when these imports come through, that'll drop back down. But again, that's something that's going to remain fairly back and forth, just in terms of where we can go. Again, just bumping along the bottom. So that's what we have for you in this segment. In the next segment, we're going to go deeper into refined products and what is happening in just the demand side of the world as we go into September.